Hi everyone, welcome back to the channel. Today we're diving into one of the most fundamental aspects of trading, understanding candlestick charts. Hi, my name is Lamia, and by the end of this video, you will have a solid understanding of how to read and interpret candlestick charts across different time frames. Whether you're trading cryptocurrency, stocks or Forex, mastering candlestick patterns and knowing which time frame to use is crucial for making informed decisions. So let's get started. So what exactly is candlestick chart? Essentially, it's a type of financial chart used to describe price movement of a security, derivative, currency or cryptocurrency. Each candlestick represents a specific time frame and shows 4 key pieces of information: the open, high, low and close price. Open price. This is the price at which the asset starts trading at the beginning of the selected time frame. High price. This is the highest price at which the asset traded during the time frame. And low price. This is the lowest price at which the asset traded during the time frame. Close price. This is the price at which the asset finishes trading at the end of the selected time frame. The rectangular part of the candlestick is called the body. The lines extending from the body are called shadows or wicks. The top of the upper wick indicates the highest price, while the bottom of the lower wick shows the lowest price within the time frame. So what candlestick colors means? If the closing price is above the opening price, the candlestick is often green. This indicates a bullish market movement, meaning the price has increased during the time frame. If the closing price is below the opening price, the candlestick is usually red. This signifies a bearish market movement, meaning the price has decreased during the time frame. Candlesticks can be used in different time frames, each serving a specific purpose. The 1-minute candlesticks are usually used for scalping and very short-term trading. They are ideal for capturing small price movement within minutes. A 5-minute candlestick are usually used for short-term trading. It helps in making quick decisions based on a real-time data. The 15-minute candlestick, often used by day traders, it allows traders to identify trends and make trades within a single trading day. The 1-hour candlestick chart is suitable for intraday traders and swing traders. It helps them to spot trends that last several hours to a few days. The 4-hour candlesticks are popular among swing traders. They provide a broader view of the market and helps identify trends that may last a few days to a week. The day candlesticks are ideal for swing traders and long-term investors. They provide a clear picture of the overall market trends, and it's used for analyzing price movement over days and weeks. The weekly candlesticks are used by long-term investors. They identify longer-term trends and patterns over weeks and months. The monthly candlesticks, they give the broadest view of the market. They show long-term trends and patterns that develops over months and years. Most traders, they start by analyzing the weekly chart, then move to the daily chart, followed by the 4-hourly chart, then the 1-hour chart, and finally to the 15-minute chart. This approach helps in understanding the broader trend and then drilling down to more specific time frame to identify entry and exit points. The choice of time frame depends on what you are looking to trade and your trading strategy. Now let's talk about some common candlestick patterns and what they mean. The single candlestick patterns, doji, has almost the same opening and closing price, forming a cross or plus sign. It indicates market indecision and potential reversal. The hammer has a small body with a long lower wick. It appears at the bottom of a downtrend, signaling a potential bullish reversal. The shooting star has a small body with a long upper wick, appearing at the top of an uptrend, indicating a potential bearish reversal. The multiple candlestick patterns, bullish engulfing patterns, a small red candlestick followed by a larger green candlestick that engulf the previous one. It indicates strong buying pressure and a potential bullish reversal. Bearish harami, a small red candlestick contained within a large green candlestick, indicating a potential bearish reversal. Now, let's break down some of these patterns with real example so you can see how they play out in the market. In this example, you can see a small red candlestick followed by a large green candlestick. Notice how the green candlestick completely engulfs the red one. This is a classic bullish engulfing pattern, suggesting a potential upward trend. Here we have large green candlestick followed by a smaller red one within the green's body. This bearish harami pattern can indicate a potential downtrend. Understanding the context of these patterns is crucial. Always consider the overall market trend and use additional indicators like volume, moving average, and RSI to confirm your analysis. Also, support and resistance level plays a vital role in confirming candlestick patterns. Support is a price level where a downtrend can be expected to pose due to a concentration of demand. Resistance is a price level where an uptrend can be expected to pose due to a concentration of supply. For example, a bullish candlestick pattern near a support level can be a strong indicator of a potential upward movement, where a bearish pattern near a resistance level can indicate a potential downward movement. Also, let's not forget, practice makes perfect. Use demo accounts to test your understanding without risking real money. This allows you to apply these patterns and strategies in real market conditions. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and hit the notification bell for more trading tips and tutorials. Drop any questions you have in the comment below and I'll be sure to answer them. Happy trading and see you in the next one.